All right, time now for the very latest from the ENCA Money Desk. Rupiwa Madziana standing by in the newsroom. I think we're obsessed with booze, Rupiwa. We just spoke about it with Ronald. And now you, the president's surprise move on Sunday to ban the sale of alcohol again has left online orders in limbo.
Yes, Shahan, I must say, if we can't drink it, we might as well talk about it, can't we? So those online orders for booze will only be delivered after the current alcohol sales ban is lifted. So online retailers say Sunday's sudden suspension of alcohol sales has compelled them to recall orders already that were ready for delivery on Monday. So here's one-day-only director Lauren Fenter.
We can safeguard that stock, we can look after it, and of course we'll deliver as soon as the lockdown ends. We'll get that stock out to the customers. So I think from our point of view, it's an absolute mad scramble and it's an administrative nightmare, very, very difficult. But our hearts really do go out to the wine farms and to the suppliers. I know, for example, many of our beer suppliers have been brewing like crazy over the last while. And once again, they're going to have to dump their stock and not be able to deliver it. I know the wine farms have been bottling, they've been labelling, they've been getting everything ready to get things delivered. And so now all of their cash flow is tied up in that, and actually they're going to need it for staff.
I'm sure those people couldn't wait to get their deliveries. Pity. Well, another global institution is weighing in on South Africa's economy. What are we hearing?
Yeah, Shahan, so more bad news for South Africa's already ailing economy. Ratings agency S&P Global forecasts that the economy will contract by more than initially projected, likely shrinking 6.9% in 2020, and that's compared to an earlier forecast of 4.5% contraction. So the ratings agency says the pandemic has worsened the country's macroeconomic situation since the last economic update. Confidence is also taken a huge knock because of the continued lack of growth and concerns about the fiscal trajectory. S&P's growth forecast is, however, more optimistic than National Treasury's prediction of 7.2% this year. In April, President Cyril Ramaphosa announced a 500 billion rand relief package. Now, S&P Global says the package will only partially mitigate the economic pressures, and coupled with lower revenues, government debt is likely to increase significantly.
Things are not looking good in the mining industry.
Not at all, Shahan. So mining production slumped by 29.9% year-on-year in May. So this is the most, as most miners were forced to operate at limited capacity. The sector declined by 47% in April, and that was in response to the lockdown. The largest contributors to the dip seen in May were iron ore, which shrank by 66.3%, followed by platinum group metals, which fell by just over 27%. Here's Jeff Noetling, who's an economist at F&B Wealth and Investments.
Due to level 4 lockdown restrictions during the month of May, most miners were only permitted to operate at a reduced capacity. This transitory hurdle, combined with low global demand for commodities, resulted in domestic mining production decreasing by 29.8% year-on-year in May. This is the third consecutive annual decline in mining output, following declines of 50.3% year-on-year in April and 19.1% in March. In line with the April print, all mineral groups recorded negative year-on-year growth, with the largest detractor from the May headline reading being ascribed to iron ore production, which contracted 66.3% year-on-year and shaved off 7.4 percentage points. This was followed by contractions in PGMs or platinum group metals, manganese ore, other non-metallic minerals, and coal. On a seasonally adjusted basis, mining output jumped 44% month-on-month in May, which can almost entirely be attributed to base effects. In fact, April and March production plunged 36.8% and 19.3% respectively. We anticipate that the June mining production print will improve relative to the previous 2 months, as most mining activity was permitted to scale up towards operating at full capacity under level 3 lockdown regulations. However, miners still have to contend with several headwinds, including containing potential COVID-19 outbreaks, lower capacity utilization rates due to suboptimal operating conditions, load shedding, as well as weak external demand from many of our trading partners.
And with that, how's the markets doing?
Stark contrast from yesterday, Sahan. So globally, some economies are returning to lockdown measures as COVID-19 cases rise faster than expected. Now, that's instilling a lot of uncertainty amongst investors. And of course, this has trickled down to the JSE, which has also suffered a little from the mining data that came through today. But let's take a closer look at how those indicators performed today.